Welcome back to Boni's Life, where we decode the complex world of finance and make it accessible to everyone. I'm Boni, and today we're diving deep into one of the most crucial skills in cryptocurrency investing: how to catch trends early before they explode into mainstream consciousness. If you've ever wondered how some traders seem to have a crystal ball predicting the next big crypto narrative while others are left chasing pumps, this episode is for you. Now, before we begin, let me be clear about something. I'm not here to sell you dreams of overnight riches or promise you the next 100x moonshot. What I am here to do is arm you with the intellectual framework and practical tools that professional traders and institutions use to identify emerging trends in the crypto space. Think of this as your graduate level course in crypto trend analysis, but without the boring professors and overpriced textbooks. The cryptocurrency market, currently sitting at a staggering $3.4 trillion in market capitalization, has evolved far beyond the Wild West days of 2017. We're now in an era where institutional players like BlackRock manage over $54 billion in Bitcoin assets alone, and where countries are creating strategic Bitcoin reserves. This isn't your uncle's speculative casino anymore, though it certainly retains some of that excitement that keeps us all coming back for more. Today's discussion will be structured around three fundamental pillars that drive crypto markets: narratives, cycles, and sentiment. These aren't just academic concepts. They're the very forces that move billions of dollars in and out of digital assets every single day. By the end of this episode, you'll understand how to identify these forces early, position yourself advantageously, and most importantly, avoid the common pitfalls that trap retail investors. Let's start with narratives, because in crypto, stories move markets more than spreadsheets ever could. A narrative, in our context, is essentially the overarching story or theme that captures the collective imagination of the crypto community. Think of narratives as the popular kids in the high school cafeteria. Everyone wants to sit at their table, and their influence spreads throughout the entire ecosystem. Consider the artificial intelligence narrative that exploded in 2024, when ChatGPT and other AI tools began reshaping how we work and think. The crypto market didn't just take notice, it created an entirely new category of investments: AI tokens, which had a combined market value of just $2.7 billion in April 2023. Surged to over $36 billion by 2025. That's more than a 13x increase in less than 2 years. BitTensor, one of the leading AI crypto projects, saw its TAO token increase by over 17% in the last year alone, reaching a value of over $425 as of June 2025. But here's where it gets interesting from a trend identification perspective. The smart money wasn't buying AI tokens when they hit mainstream crypto media. They were accumulating when AI was still a niche discussion among developers and tech enthusiasts. The key insight here is that crypto narratives often emerge from broader technological or social trends that haven't yet been fully priced into digital assets. Dean Skoker, CEO of WonderFi, offers valuable perspective on how narratives spread through crypto markets. He explains that halving cycles, for instance, tend to drive interest not just in Bitcoin, but across the entire cryptocurrency ecosystem. More eyes are on the crypto industry as a whole, Skoker notes, and other cryptocurrencies not subject to halving get investor attention, leading to surges in altcoin markets as well as innovation in the space. This observation reveals a crucial principle. Major crypto events create ripple effects that extend far beyond their immediate scope. The Bitcoin halving in April 2024 didn't just affect Bitcoin. It created a rising tide that lifted numerous other narratives and projects. Understanding these interconnections is essential for early trend identification. Now let's talk about the practical mechanics of spotting narratives before they become obvious. Blackbeard XBT, a respected crypto analyst, emphasizes that staying informed is the foundation of narrative detection. This doesn't just mean reading crypto-specific publications. It means monitoring traditional news, technological developments, regulatory changes, and even cultural shifts that might eventually influence crypto markets. The tools for narrative detection have become increasingly sophisticated. Platforms like DeFi Llama allow you to track total value locked changes across protocols, providing early signals when capital begins flowing into new sectors. Etherscan helps analyze the quality and legitimacy of emerging projects by examining holder distributions, deployment details, and transaction patterns. Social media platforms, particularly Twitter, serve as early warning systems where you can gauge community sentiment and identify emerging discussions before they reach critical mass. But here's a counterintuitive insight that separates professional traders from retail investors. The best opportunities often exist when fewer people are talking about them. If a narrative is already trending on crypto Twitter with thousands of retweets and mainstream media coverage, you're probably not early anymore. The real alpha comes from identifying themes when they're still being discussed in small specialized communities. Let's examine a recent example to illustrate this principle. The real-world assets tokenization narrative, which Edul Patel from Moodrex identifies as a key trend for 2025, didn't emerge overnight. Early indicators included increasing institutional interest in blockchain infrastructure, regulatory clarity around digital securities, and technological improvements in asset tokenization protocols. Savvy investors who recognize these converging factors were able to position themselves in RWA-related projects before the narrative gained widespread attention. Moving from narratives to cycles, we enter the realm of more predictable, though not entirely reliable, market patterns. Crypto cycles are fascinating because they combine elements of traditional financial market cycles with unique characteristics specific to blockchain technology and digital assets. The most well-known cycle in crypto is the Bitcoin halving cycle, which occurs approximately every 4 years when the reward for mining Bitcoin is cut in half. Historical data shows that previous halving events in 2016 and 2020 were followed by significant price increases of 51% and 83% respectively in the 6 months following the event. However, as Skaka points out, the 2024 halving didn't follow historical patterns exactly. Previous halvings tended to cause some volatility immediately after the event, with significant jumps in price in the 6 to 12 months following. Skaka explains, this current post-halving period did not follow the same rapid trajectory as the 3 previous events, but the positive signals sent out by both global jurisdictions and institutional investors in recent months have accelerated the interest in digital currencies across the board. This observation highlights a crucial evolution in crypto markets. As the space matures and institutional participation increases, traditional cycle patterns may become less pronounced or manifest differently. The 2024 halving occurred in a context of unprecedented institutional adoption, with Bitcoin ETFs approved just months earlier, and major corporations adding Bitcoin to their balance sheets. Marcus Thielen, founder and CEO of 10x Research, provides additional context on Bitcoin's cyclical behavior. Historically, Bitcoin has averaged a plus 10% increase in December, with blockbuster performances in 2010, 2011, and 2020, he notes. Returns have averaged 28% during halving years. Thielen's analysis suggests that even if Bitcoin achieved only half of its 2021 performance, it could reach around $150,000 in the current cycle, but cycles extend beyond Bitcoin's halving schedule. We see cycles in regulatory clarity, with periods of uncertainty followed by waves of regulatory approval that unlock new institutional participation. The approval of Bitcoin spot ETFs in January 2024 represents one such regulatory cycle completion, leading to $120 billion in institutional inflows in the first year alone. There are also technological cycles, where periods of infrastructure development are followed by application layer innovation. The current cycle appears to be transitioning from infrastructure building to practical application deployment, with trends like DeFi revival, AI integration, and real-world asset tokenization gaining momentum. Understanding these cycles requires looking beyond price charts to fundamental developments in technology regulation and adoption. Early cycle identification often involves recognizing when foundational pieces are falling into place, even before their impact becomes visible in market prices. The third pillar of our framework is sentiment analysis, which might be the most nuanced and challenging aspect of crypto trend identification. Sentiment in crypto markets operates on multiple levels simultaneously. Retail investor sentiment, institutional sentiment, developer sentiment, and regulatory sentiment all interact to create the overall market mood. Traditional sentiment indicators like the Fear and Greed Index provide useful baseline measurements, but sophisticated trend identification requires deeper analysis. The key is understanding how sentiment flows through different market participants and how these flows create opportunities for early positioning. Retail sentiment often follows price action with a lag, creating contrarian opportunities for informed investors. When retail investors are extremely fearful, it often signals accumulation opportunities for those with longer time horizons. Conversely, when retail sentiment reaches euphoric levels, it may indicate that a trend is approaching exhaustion. Institutional sentiment operates differently, often driven by regulatory clarity, technological maturity, and risk management considerations. The massive institutional inflows we've seen in 2024 and 2025 reflect a fundamental shift in institutional sentiment toward crypto as a legitimate asset class. BlackRock's recommendation to allocate 2% of investment portfolios to crypto represents a significant institutional endorsement that influences broader market sentiment. Developer sentiment provides perhaps the most forward-looking indicator of crypto trends. When talented developers begin building in a particular sector or on a specific blockchain, it often signals emerging opportunities before they become apparent to investors. The surge in AI-related crypto projects, for instance, was preceded by increased developer activity in AI and blockchain integration. Regulatory sentiment creates the framework within which all other sentiment operates. The shift toward more crypto-friendly regulatory approaches, particularly in the United States under the Trump administration, has created a positive backdrop for crypto innovation and adoption. As Patel notes, Donald Trump's pro-crypto appointments at key regulatory positions like the SEC and CFTC boosted investor confidence. Now, let's discuss the practical application of these concepts. Successful trend identification requires combining insights from narratives, cycles, and sentiment into a coherent analytical framework. This isn't about finding the perfect signal. It's about recognizing when multiple indicators align to suggest emerging opportunities. Consider the current AI and crypto convergence trend. The narrative component involves the broader AI revolution transforming multiple industries. The cycle component includes the maturation of blockchain infrastructure capable of supporting AI applications. The sentiment component reflects growing excitement about AI's potential combined with crypto's programmable money capabilities. When Microsoft, OpenAI, and Cognition announced plans to launch tokens based on their AI systems, as Patel reports, it signals that major technology companies are beginning to see crypto as a natural extension of their AI strategies. This convergence of traditional tech giants with crypto represents a significant trend that extends beyond typical crypto market dynamics. The practical tools for implementing this framework have become increasingly accessible. Dune Analytics allows you to create custom dashboards tracking specific metrics relevant to emerging trends. DeFi Llama provides real-time data on protocol adoption and capital flows. Social listening tools help monitor sentiment across various platforms and communities. But perhaps the most important tool is developing what I call narrative peripheral vision, the ability to see connections between seemingly unrelated developments. When countries like Russia and El Salvador begin using Bitcoin for international transactions, it's not just a payment story. It's a geopolitical narrative that could reshape global finance. When Thailand considers a Bitcoin payment project for tourists, it signals the potential for crypto to become integrated into everyday economic activity. The key to early trend identification is recognizing these connections before they become obvious to the broader market. This requires staying informed across multiple domains: technology, regulation, geopolitics, economics, and social trends. It also requires the intellectual humility to recognize when you're wrong and the discipline to adjust your analysis accordingly. Risk management becomes crucial when attempting to catch trends early. Early-stage trends are inherently uncertain, and not every promising narrative will develop into a profitable investment opportunity. Diversification across multiple potential trends, position sizing appropriate to uncertainty levels, and clear exit strategies are essential components of any trend-following approach. The current market environment presents several emerging trends worth monitoring. Real-world asset tokenization appears to be gaining institutional traction, with traditional financial institutions exploring blockchain-based settlement systems. The intersection of AI and crypto continues to evolve, with new applications emerging regularly. Central bank digital currencies represent a regulatory trend that could reshape the entire crypto landscape. Payment adoption represents another significant trend, with countries seeking alternatives to dollar-dominated international payment systems. The BRICS nations' exploration of a new digital currency could have profound implications for global crypto adoption. These geopolitical trends operate on longer time horizons but could create massive opportunities for early participants. As we look toward 2025 and beyond, the crypto market appears to be entering a new phase of maturation. The infrastructure is largely built, regulatory frameworks are becoming clearer, and institutional adoption is accelerating. This environment favors trends that demonstrate real utility and solve genuine problems rather than purely speculative narratives. The challenge for individual investors is developing the analytical capabilities to identify these utility-driven trends early while avoiding the numerous false signals and temporary hypes that characterize crypto markets. This requires combining quantitative analysis with qualitative judgment, technical understanding with market psychology, and short-term awareness with long-term perspective. Education remains the most important investment any crypto participant can make. Understanding blockchain technology, monetary economics, regulatory frameworks, and market psychology provides the foundation for effective trend identification. This knowledge compounds over time, making each subsequent analysis more accurate and insightful. The crypto market's evolution from a niche experiment to a multi-trillion-dollar asset class represents one of the most significant financial developments of our time. Those who can successfully identify and participate in emerging trends within this space have the opportunity to benefit from this historic transformation. However, it's crucial to maintain realistic expectations and appropriate risk management. Crypto markets remain volatile and unpredictable, even with sophisticated analytical frameworks. The goal isn't to predict the future with certainty. It's to position yourself advantageously when multiple indicators suggest emerging opportunities. As we conclude today's deep dive into crypto trend identification, remember that this is both an art and a science. The science involves rigorous analysis of data, patterns, and fundamentals. The art involves intuition, timing, and the ability to see connections that others miss. Mastering both aspects takes time, practice, and continuous learning. The crypto space will continue to evolve, creating new narratives, cycles, and sentiment patterns. Those who develop strong analytical frameworks and maintain intellectual curiosity will be best positioned to identify and benefit from these emerging trends. The key is starting now, building your knowledge base, and practicing these analytical skills in real market conditions. Thank you for joining me on this exploration of crypto trend identification. If you found this analysis valuable, please subscribe to Boni's Life for more in-depth discussions of financial markets and investment strategies. Remember, the best investment you can make is in your own education and analytical capabilities. Until next time, stay curious, stay informed, and keep building your understanding of these fascinating and rapidly evolving markets. The future belongs to those who can see it coming.